Good afternoon, everybody. Thank you very much indeed for joining this webinar this afternoon, which is being held in relation to the forthcoming EGM of India Capital Growth Fund. My name is David Cornell. I'm the Managing Director of Ocean Dial Asset Management, which runs the India Capital Growth Fund. And I'm joined by Elizabeth Scott, the fund's chairman, and Gaurav Narayan, the portfolio advisor, who is based in Mumbai. We have a short presentation to give you, and I hope you can hear me okay, and the slides you can see on your screen. Can I please request, though, that we leave the questions until the end of the presentation? And as I understand it, there are three ways in which you can ask a question. The first is to raise your virtual hand, and depending on the device you're using, you'll have to find exactly where that virtual hand is. But if you do that, we can unmute your line and you can ask a question directly. Or you can write a message in the Q&A function, and my colleague Camilla will read that out, and one of us will answer. Or indeed, you can write a message in the chat box, and again, Camilla will read that out, and one of us will answer it. So I'm going to hand over to Elizabeth now for her part of the presentation.
Thank you very much, David, and thank you all for participating in this webinar. We obviously are delighted that you have taken the time out of your days to listen to what we have to say. So thank you very much indeed. As you all know, we are embarking upon a sort of a new venture, if you like, in the next few weeks, and we will be having we've put forward two things, both for you to vote on. The first point I think really that I want to make is that we as a board recognise that for the company to have a future, performance needs to improve, the level of the discount needs to come in, we need to find a way of improving liquidity, and we needed to make costs competitive. And we hope that the proposals we've put forward deal with, at least in part, with all of these. So here you can see the proposals outlined, and the first thing that we intend to do is to introduce a redemption facility which will give shareholders the right to request the redemption of all or part of their shareholdings on the 31st of December 2021, which is in roughly 18 months' time. And that redemption facility will also occur every second year afterwards, after that, so December 2023, for example. And the exit discount is going to be roughly around 6%, at a 6% discount to net asset value. In addition, and after some discussion with the investment manager has agreed to reduce their fees from 1.25% of total assets per annum to the lower of 1.25% of the average market capitalisation, or 1.25% of the of total assets, depending which is lower. And we've also brought forward the continuation vote as well. And just as a final point on the proposals, if after any of the redemption facility takes place, we as a board believe that the size of the fund will materially impair the its future viability, we would cancel the redemption point and instead move to a realisation of the assets of the company. Thanks, David. And why have we put forward these proposals? Well, first of all, we think it's important to give shareholders the opportunity to redeem some or all of your shareholding without being reliant on market liquidity. And we're very aware that given our current size, market liquidity can be relatively small. We also expect that the redemption facility should result in a discount, in the discount narrowing, at least certainly narrowing from the point it is at present. And we hope, therefore, to address the market imbalance in the supply and demand of shares. We also believe that the reduction in the operating costs provides a more effective alignment between the investment manager and shareholders. And of course, it's beneficial to all shareholders because it reduces the costs of the company and gives a bit more back to returns. So that, if I may, at that point, I think I will hand over to David. Oh, sorry, David, forgive me. What happens if the proposals aren't approved? If the special resolution is not approved, the board has agreed that the continuation resolution won't become unconditional, and we would then be obliged to put forward to shareholders different proposals to wind up, to reorganise or to reconstruct the company. And I think another very key point on this slide is really to say that given the recent volatility in the market, the impact of COVID-19, which has clearly affected economies in India as well as around the world, as a board, we believe that the realisation of the company's portfolio at the present time, wouldn't be ideal. And we very much expect that at least in 18 months' time, the market should be in a better place than it is at present. So sorry about that, David. Over to you.
Thank you, Elizabeth, very much. I'd like to start the Ocean Dial portion of the presentation by addressing the issue of performance. Poor performance over the last 3 years is the reason why we're here today. And as the investment manager, we need to be upfront and straightforward with you as our shareholders about what has gone wrong and what steps we've taken to fix it. This is important because although the opportunity to liquidate the portfolio may seem attractive in the short term, we believe that the future upside for shareholders could be substantially greater for the following 3 reasons. Firstly, India's equity valuations are at or close to 15-year lows. Hence, we believe that this is not the time to be forcing a liquidation. Prior to the onset of COVID, India's economy was starting to show some signs of recovering economic momentum. The key structural reforms that Prime Minister Modi has put in place will, in time, lead to a stronger and more sustainable growth. But these reforms came at the cost of growth and of corporate profitability, a cost that as an investment team, we underestimated. Secondly, in the last 12 months, Ocean Dial has been through a period of quite rigorous self-examination to understand in detail the mistakes that led to poor performance in order to prevent future repetition. We've enhanced our team and our investment process, and we're playing to our strengths once more. There are fresh ideas in the portfolio, and these are already starting to deliver better returns. MCX, for example, a stock that Gaurav will talk to you about in a minute or two, is up 21% since we bought it in middle of March at the market lows. The immediate gains of liquidation are real, but there is a lot more to go for if we are given a bit more time. And my conviction on voting for the proposals tabled at the EGM are predicated on 3 issues. Firstly, the long overdue economic recovery in India, when it comes, will benefit domestic facing companies and those that have been hit the hardest, the most. This, alongside a more focused team with a more disciplined approach, confident again about performing its benchmark and its peer group, combined with measures put in place by the board to ensure that the share price trades much more closely in line with the net asset value, are those reasons that give me that conviction. For the purposes of the presentation, we decided to split the performance into 2 distinct phases. The first phase runs from June 2014, which is the time at which the last circular to shareholders was published, to June 2017, which was the time, roughly speaking, that mid-cap equity valuations peaked in India, both in relative terms, relative to large caps at about a 20 to 25% premium, and in absolute terms. This is the period following Prime Minister Modi's first election, when domestic-facing Indian mid-caps massively outperformed their large caps, as the market builds on expectations of meaningfully higher GDP growth. And as you can see from the left-hand chart, the portfolio not only outperformed its benchmark by 17% over the period, but also compounded at close to 29% in sterling terms every year over that period. The second period, which is the period on the right-hand side, represents the last 3 years, which is the period now under scrutiny. I should say at this point that in order to offset the risks incurred by the premium valuations in mid-cap equities that I referred to, the investment team took a strategic decision in late 2017 to increase the number of stocks in the portfolio in order to reduce concentration risk. And in doing so, in making that decision to broaden the number of stocks in the portfolio, we decided as a team to look for more opportunities further down the market cap curve, in the smaller cap space, where there was more apparent value. We did this whilst holding on to our core themes of private sector banks and consumer companies with specific rural exposure, in which we had and still have strong conviction. But the incremental shift away from mid-caps and into small caps contributed to stock picking errors, particularly in our selling decisions. And this, combined with a massive rotation away from mid and small caps back into large caps, which was the case globally as well as in India, was responsible for the underperformance that you can see and that you have experienced, most of which has come in the last 12 months. So what are the steps that we've taken to improve that performance? Well, there are a number of them. Most importantly has been the appointment of Tridib Patak as co-head of equities alongside Gaurav, with specific responsibility of running our open-ended fund. Tridib brings 30 years of experience to the investment team. He's managed domestic Indian equity portfolios for institutional investors both onshore and globally. He has a very process-driven approach, and whilst playing no direct role in the decision-making for this portfolio, he brings a lot of valuable support and confidence to the team. In addition, we've appointed 2 analysts in support, 1 senior and 1 junior. So the team is now 5 analysts supporting 2 fund managers running 2 funds. Secondly, we've closed our Emerging India Fund, which was in some senses a competing fund to India Capital Growth. So Gaurav's attention is now back on India Capital Growth and its portfolio, and that portfolio only. The number of stocks that he's directly responsible for has reduced from over 60 to just over 30. We've created an investable universe. We call it the House of Ocean Dial. This is 140 companies that have been approved through and by an investment committee process, and which now form the list from which the portfolio managers can construct their portfolios. One of the key takeaways that we had from our investment offsite that we set up very shortly after Tridib joined was that the investment team felt that they were just chasing too many new ideas across too many sectors and meeting too many companies in order to try and gain a more holistic approach or more holistic view of what was going on. We've decided in creating this House of Ocean Dial to limit the stocks that the portfolio managers can select to just 143. And now each analyst covers just 30 stocks. And that analyst lives and breathes those 30 companies 24/7, 365 days a year, giving more depth of understanding and more conviction. It also allows us to introduce our non-financial analysis, or our ESG framework, into our understanding of these companies. And that's also been extremely important. We've introduced a ranking tool that helps bring more objectivity, particularly to our selling disciplines. And we've introduced some artificial intelligence software that is working really well in terms of improving analyst productivity. All this comes under an umbrella of an investment committee which brings more accountability and more objectivity. And I hope will lead, and I'm confident will lead, to better performance going forward. So I shall now pass over to Gaurav, who will give you more information.
Thank you, David. As you may know, I joined Ocean Dial in 2011, and I've been managing the India Capital Growth Fund for the last 9 years. The last year has been tough. Underperformance has undone a lot of the performance we delivered in the initial period. In fact, during 2004 to 2017, we compounded at 29% per annum over that period. So as a team, we've taken a step back to assess what needs to be done to recover the lost performance. And I would say we focused on 3 areas: stronger team, refined investment process with better use of technology, and the third, a far more disciplined approach. So let me take you through what we've done with the team. Apart from increasing the team size, analyst team to 5 analysts, I would say what is important is the experience of the team members. 4 of the 5 analysts today have almost 14 years experience each. We took our time in hiring Tridip Pathak, but he's on board now. We've incorporated a lot of his practices in our revised process. So what is the result? A significant part of my time is now freed up to focus totally on the portfolio and getting the best out of the team. So let me tell you about what we're trying to do with technology. In the screen in front of you, this is what we call our ranking tool. Prior to this, we used to have detailed financial models of every company we met. By now defining a universe of about 140 stocks, what we're able to do is incorporate all these models into this common sheet, which is our ranking tool. What this enables us to do is every stock in the universe can be ranked on different financial parameters. So if you look at the box at the bottom, here we ranked our universe of 140 companies based on the absolute return expectations we have on our own valuation parameters. It adds value through 2 ways. One, it's objective. The second is it brings discipline, and the discipline is particularly in the areas of the sell decision, because one tends to get wedded to stocks you own. This has been one of our weaknesses, as David had highlighted. Now I'll take you through an example. We own a company called Ramco Cements. We bought it over 3 years back. When we bought it, we'd compared it with all other cement companies, done a thorough risk-reward analysis, and it was one of our core portfolio stocks. Over the last 3 years, the stock has done exceptionally well. But today, when we look at it in our ranking tool, it's actually ranking in the 3rd quartile in terms of absolute return expectations from the current levels, simply because it's run up a lot more than others. So when we look at it from that angle, we actually start thinking that why do we still own this stock in the portfolio? Are there better stocks in in cement companies in our universe which are now ranking higher? So it's really aiding a lot on our decision-making abilities, especially on the sell side, and which stock gives you the best return. So I would say that one has to remember this is not a tool where you'll just pick the top 30 stocks based on a ranking tool and build on the portfolio. But it's really providing you a direction in focusing on where you should really be looking at from each stock in the portfolio. Now, another way of looking at on the technology side is the next slide, where here what we are trying to do is we are trying to use technology through, this is a artificial investment software called Romulus, which we're using. What it essentially does is it aggregates data from multiple sources and puts it in one common dashboard. So it does two things. One is if any news, any interview of a company, any regulatory filing, all information is on your screen in front of you in one dashboard. The second aspect it helps is on due diligence side. For example, what you see on this screen in front of you, this is a company where we've just gone into a dashboard giving its external relationships, which it throws up who are its board of directors, who are its auditors. You click on the member of the board of director and it instantly takes you to all other directorships the person has in different companies, currently as well as in the past. Same with auditors. So it's really helping you speed up your diligence in terms of analyzing companies. So I would say it's a real productivity enhancing tool which we've acquired to really be able to be much quicker in our ability of gathering information and decision making. So both are actually having a significant impact already in the portfolio construction process. And what you see in the subsequent slide is some of the stocks we've added to the portfolio over the last few months. These 5 stocks account for about 15% of our portfolio today. But these are very interesting businesses which have strong sustainable growth momentum, more importantly at very attractive valuations. To give you a few examples, we've taken 2 companies in the gas supply chain. Both are leaders in their field. India is moving to a gas-based economy, so huge regulatory tailwinds in this space. Likewise, we've taken a position in the dominant commodity exchange in India called MCX. It's a networking business, and here too, regulatory tailwinds as the regulator has now opened up the commodity space to more participants and more products. So again, you see a long trajectory of volume growth. Likewise, the third very interesting business is ICICI Lombard, which is the largest private sector general insurance company. It's got technology leadership, it's got cost leadership, and here, besides market growth, it's also gaining at the expense of the public sector insurance companies, which are today the dominant players in the environment. So really interesting businesses, but how have they performed since we've acquired them? So what we did was we did this exercise where we aggregated the performance of the stocks which we bought since the time of acquiring them and compared it with the index. So the chart on the left, the blue line shows to you how the stocks have performed since we've acquired them, and the gray line is the index performance. So really they've been outperforming. The chart on the right reflects the stocks we've actually exited. The blue dashed line really reflects how they've performed versus the index. So we are actually we find a lot of confidence that the portfolio now we are building up is very well positioned to take us to the future. Now today, the key question is how much value is in the portfolio, especially in the uncertain environment that we are, where forecasting is slightly challenging. So the best way to analyze that is how the portfolio is valued on historical parameters. So what we did was on the table on the left, we took each stock in our portfolio, looked at its historical average valuation over the last 5 years, and then to be conservative, we said let's value it at one time standard deviation below its historical average. And to arrive at a fair value on its historical numbers, which was March 20 numbers. When you aggregate the whole portfolio, you actually get an upside of almost 15%. If we substitute the valuations with what we believe is the fair value for these businesses, the upside actually goes all the way to 40%. We then said, let's look at another parameter and look at our own historical performance and see what valuation stood in different periods of time. So the table on the right reflects how the portfolio valuations were in the period when we had our best performance and our worst performance. In 2014, our portfolio, which was at its bottom at that point of time, was valued at 15.5 multiples. Today it's trailing at about, its multiples on a trailing basis is about 16 times. So even on that parameter, we actually find that on historical level, we are actually close to the bottom on the valuations we've seen in history. To end off, we looked at where we are in the market itself, and in the following chart, we've really looked at how the market valuations are for the mid cap companies. The chart on the left gives the 15-year historical valuations of mid cap index. I would say possibly you'll never get such an opportunity again that the entire market is trading at close to its historical bottoms. In the last 15 years, there have only been 4 occasions when the mid caps have traded at these levels, and the last one being in 2013. The big question then arises, where are we relative to the large caps? And the chart on the right really reflects the performance of the mid caps relative to the large caps. If you see 2014 to 2017 is where the mid caps really significantly outperformed the large cap. But what's happened since these 3 years, the mid caps have been consistently derated such that they've actually fallen even below the 2014 gap in valuations. So the gap has only widened in this time frame. So really to end off, I would say highlight 2 factors, things we've done. One is internally, we've done a lot to address performance and have a very strong portfolio driven by a fairly revised investment process. And the second is the market itself is providing you with a lot of opportunities which you last saw in 2014. So really, I would say you possibly had a period where you could see a very strong growth momentum building up for the next 3 to 4 years. I'll end there and leave it to David to conclude.
Thank you very much, Gaurav. And thank you everyone for listening. Before we go to the question and answer session, I'd just like to summarize the reasons why we think it's the right time to support a continuation. We are at multi-year lows, as Gaurav has highlighted, for valuations in India's equity market, particularly in the segment in which India Capital Growth operates. And that, combined with the proposals the board is putting to shareholders in relation to the discount to liquidity and to costs, including a redemption facility, dovetail very, very neatly with the changes that we've made to the investment team and the investment process. And those, we think, are already showing signs of delivering better returns. So we would urge you to support the proposals, this being not the right moment for shareholders to crystallize the fund. So thank you, and let's move to the Q&A, please, Camilla.
Thanks, David. We've had a question through following Moody's announcement that it has downgraded India's rating to the lowest investment grade with a negative outlook. What are your thoughts on this announcement?
Gaurav, are you happy to answer that?
Yeah, actually, this was expected. Moody's, if you see the ratings of Moody's, S&P and Fitch, Moody's rating was always higher than the other two. So the downgrade which has happened is still to investment grade. So really, I would say it was very much on anticipated lines. So the challenge is if it's downgraded further, it goes down to a junk grade. So I would say so far it's really not had an impact, but it's something you have to watch out to. But taking India's, impact on India itself, our debt is largely domestic debt. Of our total debt, 5% is external debt. So India, in that sense, is not affected to such an extent. Moreover, I think the real impact is the cost of borrowing in the future and the impact on the currencies. So far, I would say our forex reserves are at an all-time high, and the overall debt to GDP also at about 70% is not in, I would say, a zone where you are very worried, but clearly it's going to rise. So I would say it's in anticipated areas, but really we have to watch forward on how the government moves forward. But it does limit the government's ability to push forward for growth through a lot more fiscal stimulus measures.
Thanks, Gaurav. Camilla.
Thanks, Gaurav. We've had another question through on the Q&A asking if you could give some examples of Indian companies that are falling in the small cap market.
I would say, over these last 3 years, almost 60 to 70% of the companies have fallen by over 50% in the small cap market. There have been few standout companies in specific sectors, company specific, which have done very well. But broadly, I would say the market itself has fallen a lot. And the chart which you see in front of you shows that 57% of the small cap companies are trading at below one standard deviation of the historical valuations. So it's a big fall, and this is just for this current period. But if you see, the market's actually fallen over, I think, since 2017. There have been some technical factors as well that the domestic regulator, they were finding that a lot of domestic mutual funds, which were large cap funds, were investing in small cap companies and vice versa. So there was a regulation change about 2 years back where all funds were forced to consolidate a lot of their schemes. And that led to a lot of selling by the large cap domestic mutual funds in the small cap stocks because they were not permitted to do so. So a bit of technical angle to it. But having said that, in this current environment, there's always been a bit of flight to safety, which is why there's such a big valuation gap. So really, to answer your question, I think you have a number of companies, and there are one or two even in our portfolio where the valuation, 60% of the cash in the books is 60% of the market cap. So there is a lot of comfort in a lot of such stocks. So when the rally happens, it will be very swift, I would say.
Thanks, Gaurav.
Thanks, Gaurav. How do the fund's projections for performance, given the current lows, look with respect to the political situation in India and the government's reform program?
Well, I think I would say today where we are very uncertain is on the demand side. What the government has done is they've addressed a lot of the supply side issues post this COVID issue, where they've actually, the stimulus is about 10% of GDP, most of it focused on providing liquidity to the system. We are uncertain on how demand will play out over time. What we definitely know is that, getting back to 85% of demand is very likely, but the last 15% getting back to normal is where I think they will need some aid of the government. I think, having said that, the government's policies over the last 4-5 years have really been focused on doing structural reforms, which in some set also hit the economy. And they realized it about a year back, and the big hit was in rural India. And since July last year, there's been a lot of money flowing into rural India. And the positive is that today in this entire environment, the rural markets have really picked up. One, because they've not been affected by COVID, and all the past measures over the last 12 to 18 months have started seeing the growth, also helped by very good monsoons in the last 2 years. So the rural, in fact, the rural GDP growth numbers came out about 2 days back, which was about 5.8% GDP growth versus 2.8 or 3% the year before. So rural is doing well. The government has to address this issue on how demand will take off. I think the supply challenges have been fairly well addressed.
Thanks, Gaurav. We've had one through on the costs. What is the anticipated saving in costs by the reduction in fees?
Shall I take that one? I think it basically represents the size of the discount. So we're currently trading about a 23% discount. So it's about a 23% reduction in fees, which, if my calculations are correct, is about the equivalent of £120,000. Is that right, David?
Yes, it is, Elizabeth. That's spot on. Thank you.
Thank you. We don't have any further questions at the moment.
Good. Okay. Well, if there are no further questions at this moment, let's end there. Thank you all very much indeed for listening, for participating. Please remember to vote either by going to the website, the India Capital Growth website, which will direct you to a proxy form, or indeed through your platform provider or your wealth manager. Please do your best to vote. Votes need to be registered with the registrar by the 10th of June, and so there isn't a great deal more time. And please get back to us again via the website if there is any other queries or questions you might have. And thank you very much indeed for joining.